This is TreppWire Week in Review for week ending February 25th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with our experts, Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, Russia launched an invasion of the Ukraine and the world markets reacted. Here in the U.S., stocks rebounded after selling off this morning and Treasury yields were dropping from earlier highs as investors move to ride out the volatility. Many are trying to assess the impact of rising inflation, the bruised supply chain, and whether the Fed will change its stance on raising rates as a result of the conflict. Manus, markets regained lost ground today. What accounted for the turnaround?
Well, it's a great question. I'm not sure we really know the answer to this. Let me start out by saying, our worst fears were recognized last week. We kind of hoped that cooler heads would prevail and that we would avoid seeing bloodshed in the Ukraine and live shooting, even though the rhetoric had been quite hawkish for several months. But sure enough, our worst fears have been realized. U.S. stocks tumbled for almost the entirety of the last week on the news. The Dow was down about 2,000 points or more at one point. That was over the course of several sessions, of course. The S&P has entered correction territory. It's now down more than 10%. The NASDAQ is down even more. Early in the week, the surprising thing for me was that normally when you see war begin or hostilities approaching, that usually corresponds with a big rally in U.S. Treasuries. Treasury yields fall as people run from equities and risk assets into the safety of Treasuries. For the first 3 days of this week, that wasn't the case. What we saw was an uptick primarily in the yield on the 2-year and to some degree an uptick in the yield on the 10-year, which is probably not unprecedented. It's probably happened before, but it's rare that you see interest rates going up at the same time hostilities are starting. That's what we saw Monday, Tuesday, Wednesday. Thursday was a day unto itself, right? We saw a huge drop in stocks early in the morning, which corresponded with a huge toppling of interest rates. The yield on the 10-year dropped about 15 basis points this morning. The Dow was down about 800 points. And then around midday, we started to see things turn around. Yields ended largely unchanged for the day, as did equities. And I really don't have any explanation for that other than, there's this mythical plunge protection team that they talk about in the Fed, which unleashes buying of futures and so forth to help stabilize the equity markets during times of heightened volatility. Maybe that'll be the explanation that comes out of this. But it did make for both a depressing week on the war front and a volatile week on the markets front.
Yeah, I think to just echo a little bit of your sentiment, Manus, I mean, you and I talked last week on the podcast around the Ukraine situation. And as you eloquently stated, our worst fears have come to fruition, unfortunately. Hopefully this is a quick exercise that, cooler heads can still prevail, even though there's been loss of life at this point. I think everyone's still just in a feeling out phase. I think this all probably surprised everyone, even though we've talked about it for the last couple of weeks. It's been major mainstream news and headlines, but to see it play out in real time, it just is a different dynamic.
I will throw in two other thoughts about this that take it back a little bit to the inflationary side and the commercial real estate side. Let's start with the commercial real estate side. The one thing we didn't see this week was a slowdown in lending or volatility in lending spreads that sometimes comes with heightened volatility. We did speak about this extensively about a month ago when the markets were kind of going haywire, that there's two kinds of volatility. There's the kind that happens in the stock market that doesn't touch the lending markets, and there's the kind that's in the stock market but speaks more to credit events and so forth, and that usually sends credit spreads, CMBS spreads, et cetera, skyrocketing. The takeaway from this week is even though we saw a huge sell-off in the equity markets, what we didn't see was a huge melt-up in CMBS spreads. Yes, they ticked up, I would say, 5-ish basis points on the AAA level, maybe closer to 10 to 20 basis points, maybe even as much as 25 in some areas. in the triple B minus, but it wasn't the kind of volatility that makes lenders say, we're taking our ball and we're going home until this settles down. We're not going to lend until we start to see the smoke clear. So lending is continuing apace, and that's a good thing. That may stop at some point if things get, a little bit more concerning, especially if we start to think that oil prices are going to go so high that it's going to impact supply chains even further, or people's spending appetites or other things. We'll see. The other part of it, and maybe this explains why Treasury yields went higher this week, is, one of the big talking points at the press conference from the White House earlier this week was oil going higher as a result of this war. President Biden was very clear about this. He expects oil prices to go higher. In fact, today they hit $105 a barrel. And when you're looking at higher oil prices, obviously you're talking about higher gas prices and inflationary impact on the US economy. And that may be part of the reason that we saw this unusual move of Treasury yields going up at the same time fighting began in Eastern Europe. So just my 2 cents from a guy who knows very little to nothing about war, oil, and the political scene in Washington.
So one thing we're going to talk about shortly is some of the retail earnings we've seen, and we know that supply chain is definitely an issue for many of them. We've seen a story coming out of DC that officials are going to be waiting for demonstrators after truckers have threatened to clog the Capitol Beltway in the next few days and weeks.
Well, I'll start with something kind of pithy, which is, can you clog the Beltway any more than it's already clogged on most days? One of my most avoided areas, along with the Cross Bronx Expressway and the LIE on Long Island. This particular story alarms me a little bit, and not because of the local concerns. Of course, truckers going to Washington and closing down highways has a local/painful impact. It slows down the economy around Washington. But one thing that would concern me quite a bit is, and nobody's really seems to be talking about it, is if this truckers strike action, whatever you want to call it, were to really take off at a grassroots level, and there was an awful lot of solidarity among truckers to the point where guys were walking away from their rigs and saying, we're not delivering things anymore. If there was some kind of, nationwide or even regional strike, that would be crippling for this country. And I don't think people really understand just how dramatic that would be in terms of people hoarding food, supplies being, tested, grocery stores being emptied. And, here, as in the Ukraine, hopefully cooler heads will prevail and the truckers themselves will make their point and move on. And perhaps if there's things that can be done to make their lives easier, those in power can make that happen. But that is something that is kind of out there in the ether that nobody's really focusing on. And it does scare me a little bit.
Yeah, I would agree with you, Manis. I think we've seen these things play out in real time in more regulated industries. So if you look back at the great financial crisis in the banking sector, those were determined to be systemic risks. And so the federal government jumped in immediately and bailed the banks out and came up with a strategy on how to keep the economy going. In this example with the truckers, this is a non-union workforce. Largely, it's a bunch of individuals that comprise an industry. And if they, to your point, have a solidarity pact or something that says we're not going to do this anymore, you want to define systemic risk, like go to the grocery store when there's no food on the shelves or people hoard all of the toilet paper. We've already seen that with COVID. This is just further exacerbated because of the supply chain issues that we're already seeing. So I don't think there's levers at the federal level. We saw what happened in Canada last week. I don't think any of us would say that we're in support of that or raiding people's bank accounts as a means to get people to take action and go to work. But, ideally, there's a protest, there's a trucker reunion, they make their voices heard and they can continue back on to work. I mean, we all benefit from what they do. Even if you look at some of the larger freight producers, the railroads and others, while those work groups are union, they actually have federal stipulations that say if they're deemed to be a necessity that they have to work through the strike at least reduced capacity. And we don't have that type of protection here with the truckers. So it'll be very interesting to see how this plays out. I think the National Guard's already been deployed around the DC area. So it looks like DC is taking a proactive approach to whatever strategy they do have. We're just not privy to that at this point.
Yeah, I don't like to get political, and I won't in this particular case, but in a different age with a less polarizing political atmosphere, a forward-looking politician would meet a handful of these guys at a truck stop somewhere, have some, an open hot-faced turkey sandwich and share kind of a breaking of the bread. What's your hang up here? Let's talk about this stuff. Here's hoping that, just like with the Ukraine, as we did last week, that better days are ahead.
Pivoting to the retail earnings that we've seen this week, Manis, let's talk a little bit about what we saw: Macy's, Home Depot, Lowe's, and some others.
Well, it's one of these things that when, the markets more broadly are kind of spiraling lower and geopolitical concerns are on the horizon, even good news is overlooked. And even though the earnings have been decent for the most part, not universally, it's kind of been lost in the wash a little bit in terms of people kind of focusing on this right now. We'll run through a couple of things we saw that were, hit our radar. Macy's announced this week very strong results. Their stock was rewarded for the results. They also announced that for the moment, they weren't going to separate their bricks and mortar from their online presence. I think that that's a nice sign for landlords. We talked about maybe 6 weeks ago the fact that if entities started separate bricks from clicks, that some of the earnings that they make from the clicks that might currently be subsidizing marginal stores might be taken away, and then there's more pressure to close marginal stores. At least in the case of Macy's, they said that they were going to keep them together for right now, which is good for landlords. May not be the best thing for shareholders of Macy's in the long run, but we're CRE guys and not stock guys, so we'll take the keeping of them together as a positive sign. There was a comment, I was looking for it before. I had seen it a couple of days ago, but I couldn't find it this morning. I believe the Macy's CEO said that they're back up to more than 50% of traffic coming from overseas buyers, right? We had talked about how overseas traffic, from Europe and the Far East had really kind of diminished to almost nothing with COVID. And now the head of Macy's is saying that they're seeing about a 50% return to what had been normal. And if we can get that to start crossing over into hotel usage, luxury handbag purchases, utilization of retail stores in Manhattan and Chicago and San Francisco, all of that would bode well for those various parts of the commercial real estate markets. So good news there.
Yeah, so Manis, picking up on that, I have some figures here, at least from a company perspective, not just on the foreign sales, but Macy's company net sales for the full year grew 34% to about $24.5 billion. That's compared to $17.3 billion in 2020. For the fourth quarter, they reported net income of $742 million, which is a 129% surge from the 160 in the same period a year earlier. And if you look at them from a profitability perspective, they made a profit of $1.4 billion for the full year, when in 2020 fiscal year, they had a recorded loss of $3.9 billion. So I think this bodes well, not just for Macy's, but also for Kohl's, Nordstrom, Dillard's, and some of the other retailers that, if they haven't already faced activist pressures, probably would have been in the near term. So I think we're all rooting for Macy's. It's really great to see these numbers come out. And to your point, hopefully these shoppers continue to take that money. The cities benefit from the sales tax revenues. And, maybe there's some downstream impacts, as you were saying, for hotels, restaurants, et cetera, related to this.
The other side of the coin this week was TJ Maxx, which had done pretty well during the pandemic, along with others like Marshall's and Burlington and so forth, discount retailers that still managed to get people in their doors and spend some money. Their stock was off 4 or 5% after they missed. So that was kind of a surprise this week. Not sure where that came from. You would think that even though they held up very well during COVID, that people would continue to utilize them, in the fourth quarter, and they had developed some brand loyalty, just like Burlington and others, but apparently not, and their stock sold off this week. We'll have to wait and see to find out if this is a trend for other kind of tier 2 retailers that kind of operate in that middle to lower middle class demographic. We'll see, and we'll keep an eye on that as earnings continue to roll in.
So let's pivot a little bit, Manus, to some retail that's homeowner contractor specific. We're talking about Home Depot and Lowe's here. So Home Depot stock lost steam Tuesday, even though they had stronger than expected quarterly profits, and announced a 15% increase in the dividend. They had fourth quarter net earnings of $3.4 billion on sales of $35.7 billion. It's interesting. I've noticed over the last couple of quarters when companies meet or beat expectations, sometimes the market's not favorable to them. And it reminds me of college football when you have analysts that start talking about style points. Yeah, they beat that team by 2 touchdowns, but it should have been 4. And this is fairly reminiscent of that in the marketplace. So it's interesting to see how companies can perform, beat expectations, have increased sales, increased profitability, and the market reflects negatively on them in the short term. I have a little bit more on Home Depot we'll cover, but I want to talk a little bit about Lowe's first. Lowe's reported fiscal fourth quarter earnings that also topped analyst estimates, raising its financial forecast for the current fiscal year. Revenue for the quarter and growth in same-store sales beat Wall Street expectations at $21.34 billion and 5% respectively. Same-store sales growth was 5.1%, which is exceeding the analyst expectations of 4.1%. So Lowe's also had a very strong quarter, very good earnings. The piggyback to Home Depot here is that I think we've probably talked about this in previous podcast episodes, but Lowe's caters to more of a retail consumer-focused type of clientele. They're looking for the handymen and handy women that want to take on those weekend warrior projects and come and shop at their store. Whereas Home Depot is a little more contractor focused historically, and their stores are set up a little bit more for the tradesmen and women in the field. So Home Depot actually recently announced a new store concept where they're effectively going to have almost a drive-through option for contractors to effectively drive through their storefront or their lumber yard or whatever you want to call it on a flatbed model where you could effectively drive in, get your supplies loaded up, and then leave directly from your flatbed truck. So the company's first facility is about 800,000 square feet. It allows flatbed trucks to drive through the middle of the warehouse and have heavier, oversized building materials directly loaded onto the truck in real time. So it'll be very interesting. They anticipate opening up about 40 of these across the U.S. So even though they had strong store earnings and for the quarter in their traditional model, they're making a pivot here to try to get to that last mile distribution contractor, scalability with this new concept.
It sounds like a great idea to me. Anything that allows contractors to make a better use of their time is probably a good thing. We've seen a lot of challenges, both from the labor side, getting enough people to do the kind of work that needs to be done for construction and so forth. And anything that helps these guys become more efficient, I think is a good thing. You'll notice, I left the Lowe's and Home Depot part of the conversation to Lonnie. I shy away from that stuff. I happen to be the least handy man on the planet. It just reminds me of one of the more emasculating parts of my life when I was helping one of my boys move into his dorm at Clemson a couple of years ago. And in the time that it took me not to be able to put together a Nerf hoop, I watched this other guy complete an entire loft bed unit for 2 people. And it just kind of underscored just how worthless I am when it comes to doing anything. It took me 20 minutes to fail to put together a Nerf hoop. And it kind of says everything about my technical skills.
Well, I think that maybe explains why the market reflects negatively when they have positive earnings. There's a small contingent of folks rooting for them to not succeed so they can just hire the handyman to do the honey-do list around the house.
There we go.
Pivoting to some of the property sectors, we're going to start with student housing, one that we haven't talked about in some time.
Yeah, there are a couple of good stories this week in student housing. I'll run through them very quickly. As our listeners know, we try to bucket these things in themes. We saw an Oklahoma State student housing complex sell for $48,000 per bed. This is now known as the Stillwater Student Living Facility. It was acquired by XFD Real Estate Partners for $38.1 million. It's a 732-bed complex. Why did this capture my attention? Well, it helped a 2014 CMBS loan get resolved without a loss. So in this particular case, a property that was distressed, that had become REO, comes out whole as a result of this firm student housing bid for the Oklahoma State property. Good news there. Another one we saw this week near Georgia Southern University, which I believe is in Atlanta, downtown Atlanta, if I'm not mistaken. A 780-bed property was sold for 46% above the 2017 value. The property is called the Hudson, and let me correct myself, it's not in Atlanta, it's in Statesboro, Georgia. It has been acquired by Campus Apartments. Why did this one capture my attention? Well, pre-COVID, we were talking about the fact that we had seen some distress in the student housing market, that we had seen some properties kind of fall behind in what we called the amenities arms race and become somewhat obsolete before their time. We had seen some delinquencies and some defaults, and we incorrectly predicted that that would accelerate during the COVID period. We turned out to be very wrong about that. Student housing has been a wonderful performer, but to underscore how positive the story has been, when you see a 46% gain on a property in Georgia over the last 4.5 years, that's just a home run for that segment. So good news there. And then lastly, I don't know if this is record breaking for the area, but it was just kind of amazing to me. Apartments near William and Mary sold for almost $200,000 per bed. As you parents know, it's not just the tuition that will set you back, it's also the room and board. In this case, the 240 unit, 620 bed Midtown Row complex in Williamsburg went for $122 million. That's $508,000 per unit, almost $200,000 per bed.
It's amazing if you are in the market to check out student housing right now. You will be absolutely blown away at what the facilities are like for kids these days. And Manis, I noted that one of the facilities you were talking about, the Oklahoma State student housing complex at Stillwater, has unbelievable amenities. They have a resort style swimming pool, 24-hour fitness, volleyball, basketball, and they're looking to add frisbee golf course, leash-free dog runs, and more. Like, when are these kids studying?
Well, listen, if you've seen the movie Back to School with Rodney Dangerfield, and he's walking around the dorm in his bathrobe, right? I think that's what you're going to get to at some of these complexes, that, you know, middle class, upper middle class, and even high net worth individuals are going to say, what am I doing living on Park Avenue when I can live in student housing at Oklahoma State? Look at this place. This is the greatest thing ever. And then obviously the next thing that comes with that is you see, you know, the guys with the dad bods walking down the hallway in their bathrobes. So it's just a matter of time. I may be one of them. I don't know.
Yeah, stay tuned.
Well, I think what you get here is you get that $200,000 tuition student loan, unfortunately, and then $60,000 a year job right out of college. That's where the rubber meets the road. Unfortunately, the cost doesn't necessarily justify, you know, the benefit of all those amenities, in my opinion.
Turning to malls, we've seen negative signs in the Chicago retail area.
Yeah, a couple of things we saw this week. I'll give two negative ones, but I'll close with a happy thought. You know, this was just a brutal sign of the decline of Chicago retail. Macerich sold its 50% stake in the shops at Northbridge on the Mag Mile for just 8%. That's not my microphone breaking up. It was 8% of the 2008 value. The 50% stake sold for $21 million, valuing the entire property, which once housed a Nordstrom's, at just $62 per square foot. This thing was valued at $515 million in 2008. So just a brutal comp there on the Mag Mile. Another comp we saw this week, which was not terribly encouraging, Brookfield sold a Spokane, Washington mall for just $49 a square foot. The Spokane Business Journal reported that Cohan acquired the 1 million square foot property, which is known as Northtown Mall, for $49 million. Occupancy is 80%. Cohan expects to continue using it as a mall with a plan to get occupancy up to 90%, but Brookfield throwing in the towel there. Lastly, I'll leave with a positive one. In College Town, PA, Providence Town Center, was acquired by Finmark Management and KPR for 162 million. That's a 760 square foot asset. I think it's a Wegmans anchored, it's grocery anchored. It throws off $100 million in revenue per year. The sale price equates to about $213 per square foot. And we will, close on that. That's a good one. Let me give credit where credit is due. That last story was Natalie Kostelny of the Philadelphia Business Journal. The first one, if I'm not mistaken, was the Crane Chicago Business. And indeed that was Albie Gallen. So make sure I give credit for the guys that broke these stories.
Manis, you mentioned the Magnificent Mile being an issue. One of the things I noted was that Crane's reported, citing Cushman and Wakefield, that their vacancy rate has risen to 26% in the last year from 5.3% in 2017. So that continues to be a struggle for them to attract retailers to that region. And similarly, in the Spokane Mall story, they've got a list of tenants of JCPenney, Barnes & Noble, and Kohl's. So I'm hoping they have some other ideas as to how to get up to the 90% by the year end, because it's not going to happen with that lineup.
Yeah, I mean, it'll come as no surprise to anybody that malls have been challenged. And the further you get into the alphabet, the B's and the C's, the more the challenge has been. I do have one more happy story that I'll get to in just a minute, but I don't think it gets any less challenging for the B's and C's, going forward. I think what we are in right now is a situation where they're treading water. So it may not get considerably worse. Values have been cut, tenants have been lost, but we're not seeing a real uptick in people throwing in the towel or foreclosures happening or big losses. So I guess when I say it doesn't get any easier, it also may not get any worse. We're just kind of in this purgatory where B and C malls are what they are. If you're a CMBS investor, especially down the credit curve, you hope that they muddle through. And if they do get liquidated, that the price is not 10 cents on the dollar. We can only keep our fingers crossed. I think on the higher end, the Class A's, they continue to muddle through. I don't think that they're seeing any meaningful uptick in value, but at least they're performing. They're throwing off good cash. They're keeping their mortgages current, and they are able to refinance in most cases. I'll turn to one more story that I saw today, which I kind of love. This came to us from a reader, or listener, I should say, who sent us this story, and I love this. They're talking about, the story comes from Chain Store Age, the website Chain Store Age, a story written by Al Urbanski. And he talks about Noel White, who runs a CNY Maxx store in the Great Northern Mall near Syracuse. There were once 50 stores in it. Now there's only 17. The property is owned by Cohan. He says it's falling into disrepair. The parking lot's a mess and everything else. And he said he wants to team up with other fellow renters in the building and buy it from Cohan. He thinks it's that important to the community to keep this going, and he's willing to put his money where his mouth is. And I like the old quote from Andrew Jackson, one man with courage makes a majority. And it sounds like Noah's that one man with courage. And I hope it works out for him. There's a little bit of Tommy Boy / Sandusky, Ohio, in his willingness to go after this. And I hope it works out for him.
Yeah, let's pivot away from the retail stuff here for a moment, Manis, and talk a little bit about one of the property sectors near and dear to my heart, which is the RV park. So we have a story coming out of St. Augustine, Florida, a transaction that just took place at $73,000 per RV spot. So Key International and Wexford real estate investors bought a 208 spot Ocean Grove RV resort in St. Augustine for $15.1 million. According to the reports, for an 18-acre RV resort, it's got 208 pad sites for RVs. It's situated just off A1A South, just across the street from the beach. It's the first acquisition for Key International outside of the hospitality development space where they usually reside. Company developed Embassy Suites in St. Augustine Beach, just a few miles north of the campground, and now they're venturing into this RV park arena. So I think this is very interesting. I can remember the days when you could buy an RV park and you would pay less than $10,000 a spot for that and feel like you were probably overextending yourself. And now we have stuff trading at near 100,000 per spot. I don't have any of the financial details here. I'd love to see what that actually produces in income and revenue, how they plan to continue to monetize this. Is this going to be for long-term stay? Are they going to park some RVs on there and then market it through an Airbnb type of model where they get to increase the nightly rate, or what that looks like? But just found this kind of interesting, 73,000 per RV spot for this latest RV deal down in Florida.
Well, St. Augustine is interesting. I was there over the holidays when everything in New York was shut down, and it was teeming with tourists and people, and you would not have known that it was in the middle of COVID.
I have to say, I do like St. Augustine as a town. I think it's a quite interesting place to be. Got some great restaurants, a lot of neat architecture around there. And now, I'm not an RV guy, but if I'm going to be an RV guy, I want to be by the ocean. I think that sounds like a pretty enticing place to be. And it probably has something to do with the fact that they got such a nice price for that asset.
So a couple of weeks ago, we talked about a wave of defeasances that we noticed in the mall space. And back in 2019, our team did some research that showed that defeasances grew in conjunction with lower interest rates. But there may be some other factors that might make this transaction appealing. And obviously, we've been talking about interest rates rising. So what is the thing that makes this appealing?
Well, let me take a step back and we'll talk about what a defeasance is for those that are not active CMBS borrowers or don't tap lending that has lockout and defeasance as its prepayment restriction. Normally, when you go into 10-year debt in the CMBS market, you are subject to a lockout. If you have a 120-month loan, often that loan is locked out for 116 periods, something like that, or 112 periods, 110 periods, right? So you have a small window where you can prepay freely, but you still can sell the asset and de-encumber it, if you will, by defeasing the loan. And what that means is you buy US Treasuries to replace the cash flow that the loan would have produced. So just to put some numbers around this, suppose you had a $20 million loan on a hotel that had a rate of 5%. Suppose that you wanted to refinance this for whatever reason, because you knew you could borrow at 3%. You can't pocket that 2%, right? You don't benefit from the economic value of that 2% like you would if you were refinancing your residential home. Right? If you were to refi your 5% mortgage into a 3 on your home, your private home, that 2% savings really accrues to you. Your payment goes down every month. Here, for that commercial property owner who is locked in for 10 years fixed, what you need to do is go out and buy treasuries to replace that 5% cash flow for the time that exists till the end of the loan. So a lot of people, the only time they do defease is if they want to sell the asset, and they could sell the asset at a substantially higher price than when they originally took out the loan, and they can kind of dismiss the cost of defeasing, which can be substantial. It could add up to 10 or 20% of the loan balance, depending on how long your loan has to go. For example, if you were going to save between 5 and 3% on your rate for 10 years, for almost 10 years, that's a 20 percentage point savings nominally, not in present value terms, that you would discount back to get your yield maintenance cost, your defeasance cost. And that could add up to 15%, 16%, 17%. The reason this jumped to the front of our queue this week and why we wanted to talk about it was that right now we've seen a big uptick in short-term interest rates. We've seen the yield on the 2-year go from about 10 basis points to about 160 basis points. So if you had something with like a 4% coupon with 2 years left, and you looked at it 6 months ago and said, God, the cost of defeasance is just way too high, I don't want to do that, it might be worth another look. Because now that loan, the cost of defeasing that would be about half of what it was 6 months ago, give or take. More time has rolled off on the loan, so you have less to fund from your defeasance cost. And in addition, the treasuries that you're buying to replace that 4% cash flow are now a lot cheaper to buy because yields are higher. Now, there's a lot of inside baseball for that. And Lonnie and Martha, by all means, throw in any color you have if I've gone way over people's heads. But if people don't understand this, what they want to, feel free to email us at podcast@trepp.com. And we're happy to kind of go through the math and go through what we're talking about. It's a little bit of inside baseball, but what we saw last month was Simon Properties defeased several of their loans, about $800 million worth. Probably the calculation that defeasance costs were much lower than they had been 6 months earlier. I'm sure that factored into their calculation here. And those $800 million in defeasances, those were mall loans. So not the easiest thing to decide to refinance. So again, if you have questions on that, just ping us and we're happy to kind of go through the math on a one-on-one.
Yeah, I was getting my HP 12C calculator out for that one, man. So I was getting a little bit excited. The nerdy side of me was getting pumped up about that. So I think you gave a really great overview on that. It is something unique to this securitized, financing structure that we track here. And certainly, as Manus pointed out, if you have any questions, we'd love to walk you through how that calculation actually works.
Periodically, somebody will ask me, what I do for a living, in a social setting, and I'll forget that I'm not at work, and I'll go through one of these really dry subject matters until the time where I see their eyes start to roll up in their head and, they're calling for morphine. It doesn't happen often, but maybe once or twice a year. And the person, will walk away and I'll never see them again, right? They will go out of their way to never, ever engage me in that regard. It's kind of like on a social level, it's kind of like waterboarding.
Well, I can tell you, it happens to me a little more frequently. And I find myself apologizing a couple of times a week for getting too excited about this nerdy stuff. I'm like, you mean you're not as excited as I am? And they're not. And so I have to apologize for boring them with some of those topics. But listen, like you said, Simon and those other companies are doing those calculations in real time. And when the time is right, they take advantage of that. And I think you gave a really good explanation of a real life example of how this actually plays out in the marketplace.
I know in the next week, our analyst, Jack LaForge, will be publishing a defeasance piece probably in the next week. So keep an eye out for that. If you're interested, give us a shout and we'll let you know when that comes out. Speaking of shout outs, we have a few. Oz, the illustrious Oz, gave us some feedback and said that our pod is only one of 3 that he listens to regularly. And I'm not going to tell you who the other 2 are. You have to figure that out. But thank you, and keep an eye and ear out. Oz may be on the pod at some point soon, so stay tuned for that. Private Eye Capital on Twitter suggested our podcast as a go-to CRE listen. Donut Shorts gave us a hat tip for the story about Versace taking over Givenchy's lease at 747 Madison, and Manus even pronounced it correctly. So kudos to you, Manus.
We do have another story about that particular lease and those luxury retailers. Tune in next week. We're going to talk about that. Has to do with another Midtown Manhattan property that has some high level retail lease exposure. Tease that up for our next podcast.
And Max N enjoyed the cash register sound effect from last week's episode. If you paid attention, Haley carefully put that in there at the appropriate moment. So if you hadn't listened to last week's, go back and find it. Our Trepp alum, Joe M. Yes, if you remember Joe M., he did send us an email. I think he misses us. He loves Manus's new all rights, and he had some interesting comments about the Carl Icahn battle with McDonald's over their pig crating. So if you don't know about that story, you might want to Google and read up on that one. And last, MC from Indiana says Manus's recent comment about lenders going from Ford Explorers to Porsches is less likely given the cargo ship that was carrying thousands of luxury cars was on fire and adrift earlier in the week.
I'm trying to think what would alarm me about being on fire and adrift that would really get my attention. I'm not a car guy. I am completely utilitarian when it comes to that. It's what I need for the fairest price, so I've never really owned a muscle car or something like that. I wish I was, it's kind of like, I wish I could assemble that Nerf hoop faster. I wish I could be a muscle car guy, but I'm not. I can't get myself to spend that kind of money.
Do you drive a Prius?
I don't drive a Prius. I drive a Jeep. I have a big family, so it comes in handy. But I'm trying to think, like, what is that one thing floating in the ocean where I thought, God, if they don't get that thing to the shores very quickly, I'm going to go out of my mind. And I'm really at a loss. Like, the only thing that comes close, and this had nothing to do with shipping, was during COVID when we had no Major League Baseball. I was watching axe throwing and cornhole and
The Tiger King.
that tag game. You ever see the tag game?
Oh, yeah.
My Sports Jones was in really high demand then, but I can't think of anything that might be at sea that I'm so desperate for.
Well, I can tell you, Manus, if you ever make your way down to Texas, let me know, because I have a couple of muscle cars. I am a muscle car guy. Me and my dad have restored old muscle cars for my entire life, and so I have a couple of 1968 Dodge Darts 440 engines, and I'll take you for a ride in them. It's pretty exhilarating. So I won't admit or deny if I was trying to crowdsource an expedition out to this floating ship at sea while it was on fire for some Porsche electric race cars. Unfortunately, I wasn't able to get there fast enough. I saw something that said ships that are abandoned in international waters, like it's first come, first serve, but I couldn't get the funds to get out there.
Get a jet ski, man. Get out there. With that, we will close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment and you want to send us an email, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.
All right.